In this video, you will learn what events led to the Great Depression. The Great Depression lasted from 1929 until the start of World War II. We're going to break this section down into two parts. In this video, we're going to cover the years in which Herbert Hoover was president, from 1929 to 1933. He was the third Republican president in a row and held the same laissez-faire attitude towards business as Harding and Coolidge. As the 1920s advanced, serious problems threatened the economy. Key basic industries barely made a profit. Railroads lost business to new forms of transportation, trucks, buses, and automobiles. Coal mining was hard hit due to competition from new forms of energy, such as hydroelectric power, fuel oil, and natural gas. An important economic indicator was the number of new houses being built. When that number drops, so do jobs in related industries such as furniture manufacturing and lumbering. Agriculture suffered too. After World War I, international demand for American crops such as wheat and corn increased. This was a result of the destruction of crop fields in Europe during trench warfare. Increased demand led to increases in prices. Looking to take advantage of this, farmers planted more and took out loans for land and equipment. After the war, prices fell by over 40%. Farmers increased production by hoping to at least sell more crops for money. It backfired. Prices fell even further. Those farmers who had gone into debt couldn't pay off their bank loans. They lost their farms when banks foreclosed and seized their property as payment for their debt. As farmer after farmer defaulted on their loans, rural banks began to fail. Auctions were held to recoup some of the bank's losses. During the 1920s, Americans bought consumer goods on installment plans, buying now and paying later. Credit, or the ability to pay later, became too easy to obtain. Most Americans bought goods that they couldn't afford, putting them in debt. Because the economy was so good, Americans believed that they could just pay it off later. This would lead to problems later in the decade. Herbert Hoover won the 1928 presidential election easily. Most Americans were happy with the previous 8 years of Republican rule, so they kept them in power by voting for Hoover. By 1929, some economists had warned of weaknesses in the economy, but most Americans maintained confidence in the economy. Those who could afford it invested in the stock market. The Dow Jones Industrial Average was the most widely used barometer of the stock market's health. The Dow is a measure based on the stock prices of 30 representative large firms trading on the New York Stock Exchange. By 1929, almost 4 million Americans owned stocks. The problem was that people were engaging in speculation. They bought stocks and bonds on the chance of a quick profit while ignoring the risks. Many began buying on the margin, paying a small percentage of a stock's price as a down payment and borrowing the rest. Similar to the installment plan, investors borrowed money to invest in the stock market. This works well if stock prices go up. You can sell stock to pay off the loan. If the stock price goes down, not only have you lost your investment, but now you owe money on top of that. With easy money available to investors, the unrestrained buying and selling fueled the market's upward spiral. The government did little to discourage such buying or to regulate the market. In reality, the prices did not reflect a company's worth. Worse, if the value of the stocks declined, people who had bought on margin had no way to pay off those loans. In September 1929, stock prices peaked and then fell. Confidence in the market started to waver, and some investors quickly sold their stocks and pulled out. On October 24th, the market took a plunge. Panicked investors unloaded their shares, but the worst was yet to come. On October 29th, Black Tuesday, the bottom fell out of the market and the nation's confidence. Shareholders frantically tried to sell before prices plunged even lower. The number of shares dumped that day was a record 16.4 million. Additional millions of shares could not find buyers. People who had bought stocks on credit were stuck with huge debts while prices plummeted, while others lost their savings. The stock market crash signaled the beginning of the Great Depression. There were 5 factors that led to the Great Depression. In 1930, Congress passed the Hawley-Smoot Tariff. Remember, a tariff is a tax on imported goods. The Hawley-Smoot Tariff was the highest protective tax on imports in U.S. history. Congress was trying to protect U.S. businesses and workers, but it backfired. Other countries raised their own tariffs too. Reducing the flow of goods into the United States prevented other countries from earning U.S. currency to buy American goods. The tariff made unemployment worse in industries that could no longer export goods to Europe. Within a few years, world trade had dropped by more than 40%. As farmers' incomes fell, they bought fewer and fewer goods and services, but the problem was much larger than that. Americans began buying less. As prices rose, wages did not. Not to mention that most Americans had overbought on credit in the early 1920s. They were living beyond their means. They often bought goods in a credit arrangement in which consumers agreed to buy now and pay later for purchases. Many people had trouble paying off their growing debts, so they cut back on spending. Another cause of the Great Depression was the uneven distribution of income. This simply means that the rich were getting much richer, while everyone else was getting poorer. Almost 70% of Americans were living below the poverty line at that time, which was a family that earned less than $2,500 per year. Only 1% of the population earned over $10,000 per year. If most Americans are impoverished, they can't purchase goods to keep the economy going strong. The Federal Reserve made some mistakes in their monetary policy that contributed to the Great Depression as well. Remember that the Federal Reserve controls the money supply. In 1921, interest rates were low, which encouraged consumers to purchase goods on installment plans. This led to many banks taking more risks, loaning money to businesses that began to overproduce their consumer goods. With too many goods on the market, they were forced to lay off workers to cut costs. In 1928, the Federal Reserve raised interest rates, restricting the availability of credit. With credit limited, Americans bought less, further hurting the economy. After the stock market crash of 1929, Americans lost confidence in the financial system. People rushed to pull their money out of banks as soon as they could. Banks take your deposits and loan them out to other people to earn revenue as interest. So they don't have enough cash on hand to give every customer their money. When the banks run out of cash, they had to close. Many Americans lost their savings when their bank ran out of money.